Ever wondered how you can get rich with just a small capital? It's a universal dream, isn't it? The allure of wealth, the promise of financial freedom. It's something we've all yearned for. Yet many of us are held back by a common misconception. The belief that we need a massive pile of cash to get started on the path to riches. But what if I told you that's not the case? Well, you might be surprised to learn that it's possible to get rich with just a small capital. The secret lies in the power of compound interest. Now you might be wondering, what's compound interest? Well, let's dive into it. Think of compound interest as a snowball rolling down a hill. As it rolls, it gathers more snow, getting bigger and faster. Similarly, compound interest is the interest you earn on both your original money and on the interest you've already received. It's your money making more money, which then makes even more money. Now let's break it down with a simple example. Imagine you have $100 and you put it in a savings account with an annual interest rate of 5%. By the end of the first year, you'll have earned $5 in interest, bringing your total to $105. The next year, you'll earn 5% interest not just on your original $100, but also on the $5 you earned in interest. So, you'll have $110.25. As years pass, this process repeats and your money continues to grow faster and faster, much like that snowball rolling down the hill. But here's the kicker. Time plays a crucial role in this process. The more time your money has to grow, the more powerful compound interest becomes. Let's say you start saving at 25 instead of 35. Those extra 10 years could mean the difference between a comfortable retirement and a struggle to make ends meet. The beauty of compound interest is that it requires no extra work on your part. You simply let your money sit and do the heavy lifting for you. It's not about being rich to start with, it's about being smart with what you have, no matter how small. To sum it up, compound interest is like a trusted friend who works tirelessly to increase your wealth. The only thing it asks in return is time. Time to roll that snowball down the hill, gathering more and more along the way. So, the earlier you start, the more your money grows. Now, where should you invest your small capital, you may wonder? Let's dive into that. A key principle of investing is diversification. Picture it like this. If you're betting everything on the success of one venture, you're essentially walking on a tightrope without a safety net. Diversification, then, is like distributing your weight across multiple ropes. If one fails, you've got others to fall back on. But what exactly does diversification look like in practice? It means spreading your investments across different asset classes. These can range from equities, bonds, real estate, to even commodities like gold. Each asset class has its own set of risks and returns, and they often don't move in the same direction at the same time. When one goes down, another may go up, and this can help balance out the overall risk of your investment portfolio. Now let's talk about risk management. Investing by nature involves a level of risk. However, this doesn't mean you should shy away from it. Instead, managing risk is about understanding it, quantifying it, and making informed decisions accordingly. A good starting point is to assess your own risk tolerance. Are you comfortable with high-risk, high-reward investments, or do you prefer a more conservative approach? Your answer to this question will guide your investment choices. Another crucial aspect of risk management is to regularly review and adjust your investment portfolio. Market conditions change, and so should your investments. If an asset class is not performing as expected, don't hesitate to reallocate your capital. In summary, diversification is about spreading your investments across different asset classes to minimize risk, while risk management involves understanding and making informed decisions about the risks you're willing to take. And here's something to remember. Investing isn't about chasing the highest returns. It's about achieving a good balance between risk and return. So don't be tempted to pour all your capital into the latest hot stock or crypto craze. Remember, don't put all your eggs in one basket. Diversify. Consistency, they say, is key. And when it comes to wealth creation, this adage holds truer than ever. In this segment, we're going to discuss the importance of consistently investing over time, irrespective of market conditions. Imagine you're at a buffet. You wouldn't pile all your food onto your plate in one go, would you? Instead, you'd likely return to the buffet multiple times, each time adding a little more to your plate. The same principle applies to investing. By consistently investing small amounts over a long period, you can reduce the risk of making large investments at the wrong time. This strategy is known as dollar cost averaging. It's a simple yet powerful concept. You invest a fixed amount of money in the market at regular intervals, regardless of the price of shares. On some occasions, you'll buy when prices are low, and other times when they're high. Over time, the highs and lows average out. potentially reducing the impact of market volatility on your investments. But why is this so important? It's because of a simple yet profound truth. The market will fluctuate, but it has historically trended upwards. By consistently investing, you're not trying to predict the market's highs and lows, which is a fool's game. Instead, you're riding the market's long-term upward trend. Consistent investing also has another advantage. It instills discipline. By making investing a regular habit, you're likely to stick with it, even during market downturns. This discipline can be the difference between success and failure in investing. But remember, consistent investing isn't about making quick profits. It's a long-term game. It's about building wealth slowly, steadily, and surely. It's about letting your money work for you, day in and day out. So, keep investing, consistently and patiently. Don't let short-term market fluctuations scare you off. Stay the course and let the power of time and compound interest do their magic. Remember, it's not about timing the market, but time in the market. So, keep your eyes on the horizon and your hands steady on the wheel. Your financial future awaits. How about making money while you sleep? Now, that's an intriguing thought, isn't it? Welcome to the magic of passive income. This is the kind of income that doesn't require your constant direct involvement. It's money that you earn even when you're not actively working. It's like a wonderful dream where your bank account grows, whether you're sipping coffee in your living room or sunbathing on a beach. Let's dive deeper into the concept. Passive income is essentially money earned from an enterprise in which a person is not actively involved. This doesn't mean there's no effort involved at all. It requires an initial investment either of time or money, but the key is that it generates returns for you long after that initial investment. Imagine a snowball rolling down a hill. You give it a little push at the start, but once it starts rolling, it keeps growing on its own, collecting more snow along the way. That's the beauty of passive income. You plant the seeds and then you reap the fruits over time. Let's talk about a few examples. One of the most common sources of passive income is rental income from real estate. You purchase a property, rent it out, and voila! You've got a steady stream of income. Another example is dividends from stocks. You invest in a company's stock, and when the company does well, you receive dividends. You're essentially getting paid for owning a piece of a company. There's also peer-to-peer lending, where you act as the bank, lending your money to others in exchange for interest payments. Or consider creating a blog or a YouTube channel. Once you've built a following, you can earn income through advertising revenue, sponsorships, or selling products. The possibilities are numerous and the potential rewards substantial. The trick is to find what works best for you, invest your time or money wisely, and then sit back and watch as the magic of passive income takes effect. Passive income can be your ticket to financial freedom. So, are you ready to hop aboard the passive income train and journey towards a richer life? So let's recap what we've learned. We kicked off with the allure of wealth and the dream that it is within reach, even if you're starting with a small capital. The key to unlocking this dream? Understanding and leveraging the power of compound interest. Remember, it's not about the size of your investment, it's about the time you allow it to grow. This is where the magic of compound interest comes into play, turning your small capital into a growing wealth machine over time. Then we moved on to diversification and risk management. Spreading your investments across different assets can help mitigate risk. It's like not putting all your eggs in one basket. This way, even if one investment doesn't perform well, others might, balancing out your overall portfolio. Next, we delved into the importance of consistent investing. It's not about timing the market, but time in the market. Regular investments, no matter how small, can accumulate to a substantial amount over time. Lastly, we explored the magic of passive income. This is the income that keeps coming in even when you're not actively working for it. It could be from rental properties, dividends, or online businesses. Passive income can provide an additional stream of income, accelerating your journey to wealth. Remember, getting rich with a small capital is not a get-rich-quick scheme but a journey. Start today, and you'll thank yourself in the future.